Good evening. My name is Peter Resnichek from ShadowTrader.net, and this is another edition of the ShadowTrader Video Weekly for Sunday, May 3rd, 2020. Is the rally over? I figured I would title the video that because I'm sure that is the question that is on the minds of almost all traders and investors after Friday's rout, which came on the heels of an extremely large rally. In this video, I'm going to break down a lot of market profile and technical analysis nuances that are going to show you that the actual picture is really kind of cloudy. Many people are thinking that was it. The market has to crash from here, but I'm always trying to be as objective as possible and show you all the things that you need to be looking at for next week's trade. So I'm going to show you 4 specific things on a technical nature in the charts, and then I'm going to show you 2 specific things you need to pay attention to in a market profile, and also included in that market profile section, a special tip and trick that you can use to make money if it sets up again. All right, last but not least, I have found 2 charts that seem to be bucking the trend. They were not bearish at all on Friday. They tie in with the whole coronavirus vaccine potential, and the charts look great, so potential longs there. I'm going to share both of those names with you at the end of this video. All right, without further ado, let's get into it. Okay, so what we're going to do in the first part of the presentation is we're going to look at the major averages that we always look at, which are the S&P, NASDAQ 100, and Russell. And we're going to look at 4 specific things on each of those charts to see how those things are either alike or divergent. And those 4 things are going to be the Fibonacci levels, the trend lines, the weekly charts, and the monthly charts. So let's start with the Fibonacci levels. I've been talking about the 61.8 in both the SPX and the NDX for a little bit of time now. And in this particular trading week that just passed, we breached the 61.8 to the upside, which was a bullish sign for the S&P, but we were not able to follow through after that. Notice that we only closed 1 daily bar above the key retracement level, and then spent the next 2 days, Thursday and Friday, falling back down. All right, so keep that in mind. That's on the SPX. Now in the NDX, remember there's been a lot of divergence here, much stronger. We actually broke this level a long time ago. We closed many daily bars above it, and now in the subsequent selling Thursday and Friday, we haven't even come back to the 61.8 yet. Right? Notice, as I was saying earlier, the S&P has fallen below it. The NASDAQ 100 is still well above it. So I don't really see any strong selling as such in the NASDAQ. Last but not least, the Russell. The Russell was not able to get up to its 61.8. It only found resistance at its 50, and then since then has fallen back. So you see, that's the first part of our analysis here, is look at where the major averages are in relation to the fibs, and we can see clearly that there is a lot of divergence. All right, moving on to the next piece of analysis, which is the trend lines. We're going to just take a look at and see how are all of the majors faring in relation to their uptrend lines, starting from the recent, what I call coronavirus lows down in here. Notice that the S&P formed its trend line like this, and again, just recently, it's only been 1 day, only on Friday of this week did we actually trade below the uptrend. But that being said, keep in mind where our moving averages are. Our MAs generally will catch price on the way down. So one of the focuses that you want to have for early next week is the 20-period moving average in the S&P at that 2791 to see if it holds or gets breached, okay? So there's S&P just dipping below the trend line by a little. NASDAQ dipping below the trend line by even less, just barely basically on Friday. And notice the distance here between the low on Friday and the 20-period moving average. So it's still got plenty of room to fall, but it's technically, the way you want to look at that is that it is clearly still showing relative strength because it is further above that key moving average, right? So there's a little bit of divergence there as well. And last but not least, Russell, I've struck the trend line in the same manner here from the coronavirus lows. And notice where we are, well above the 20, and you've got all this room before you even get to the trend line. So what does that tell you about the Russell? It tells you the small caps have been showing risk on for a hot minute here or so, and they're still well above the trend line. And this is the push-pull that I often talk about that makes things slightly difficult because these indices are out of sync. So far, in the first part of our analysis, which is just first and second part, I should say, Fibonacci's and trend lines, the markets are way out of sync, and there's a lot going on here technically in terms of what's breaking, what's not breaking, what has support coming up from moving averages just below us. In the case of the Russell, notice support is still going to come in terms of the trend line. All right, and the way you want to look at this stuff in terms of your trading going forward is understand that because these technical events are all out of sync, very often what traders do is they make the mistake of not watching all of them, and they hang their hat just on one. And for instance, they might get very bearish on the S&P, for instance, at the wrong time, right when, let's say, the Russell is just coming into this line. And then they wonder why their short got blown up because they're not paying attention to all three. All right, so remember that. They're going to be out of sync. Some are going to move faster than others. Some are going to move ahead of others. But then when they move ahead, others may just be coming into support. So you have to be aware of that. The best and strongest signals are always when all of the three major averages are all in sync. And for instance, they were all under the trend lines, all under the 20 MA, correct? All backing off from under the fibs, well below all at the same time. So keep that in mind. All right. Third point I wanted to mention is I wanted to take a look at weekly charts to show you how those diverge. If you look at the S&P on its weekly, and I'll get rid of the trend line so you can see the candle clearer. I'll make it a little bit bigger. Clearly, the S&P has a bearish bar, which is this inverted hammer. Now, I don't put a lot of stock into hammers or inverted hammers. Personally, I think it's kind of it's misleading. A lot of people put a lot of weight in that, especially newer traders. I know when I first started watching charts many years ago, I would always look for these shadows and think, oh, that the market would have to trade opposite it, but it doesn't. Sometimes I think in the longer time frames, it tends to work much better than the shorter time frames. Certainly in the intraday time frames, the shadows, the hammer type bar doesn't mean as much, but I will say there is some weight to it if it's in a weekly or a monthly. So in this case, weekly chart, S&P does have an inverted hammer, so the potential is there to trade lower. But here's where things get interesting. If we look at the NDX, it's not a hammer really at all. There's really almost no upper shadow to it. And you can see that on a weekly basis. Notice where is the majority of the action here in the body of the bar. It's the same as the body of the bar of the prior week, and it's here in the upper third of the prior week. So again, the point I'm trying to make is as far as the NASDAQ stocks are concerned, or NASDAQ 100 specifically, there really has been not much of a pullback, and the weekly charts look very different. Okay, last but not least, let's go into the rut. Also a large topping tail, so if you believe that means we'll trade below it, potential is there. Only thing I would say with the rut is a caveat, be careful. The tail is really large. A lot of times when the tail is that big, you have the propensity to trade back up somewhere into the tail before you go down. So just keep that in mind. And last but not least, as I always like to say, the monthly charts are the last technical analysis nuance that I want you to look at. We're going to look at the monthlies of the SPX, NDX, and Russell because obviously a month just ended. Remember, monthly charts really only make sense to look at right around when the prior month ends, not in the middle of the month when the bar is still forming. I'm going to expand this a little bit, take off the Fibonacci so we can see it clearly, and obviously we're looking at this bar, which is April. This tiny bit here is the first trading day of May. And if you look at the monthly charts, basically it's not bearish. It's a huge bar. April was extremely bullish. You could say that it is an inside bar, which gives it a little bit less weight in terms of the bullishness because you can call that kind of a harami. But technically a harami is really when you have the body and then you've got the other body inside of the body like this. So this is not really all that much of a clean pattern because you've got this tail here. But I'm just saying at first glance, if I was to look at this, I would not be seeing really anything bearish in the monthly chart. Think about it. In order for this whole thing to get really bearish, we would have to retrace this entire movement. Now, granted, could volatility pick up? Could we retrace the whole thing and have a candles lining up, same size bodies pattern where you have green and then red and they're both lined up? And obviously you go with the second one, which would be red. So the next move eventually into the summer would be down, potentially. But I'm just saying, let's just look at what we have in front of us right now, and I'm just looking at the monthly of the SPX. Does not seem all that bearish. Now, NDX, if the S&P didn't look bearish, what does the NDX look like? really not bearish. Notice that here, instead of closing somewhere here at the high, we actually went all the way to the prior month's high, even taking out this shadow and closing right at the top. And again, this is just the May activity of the first day after the gap down. So again, if I was looking at just the NDX and I was just looking at monthly charts, I would say, looks really bullish. What I would be thinking is basically whenever you have a big body candle like this, the rule of thumb is you look for a 50% retracement somewhere into the body of it and you buy it, right? So, all right, that's the NDX, and last but not least, RUT. And again, we'll expand, take off the Fibonacci so it's clear, and probably more similar to the S&P, correct? In terms of having that as an inside bar, kind of piercing up into the body. You know, obviously the RUT is kind of its own animal, looks a lot different, trades a lot different. So just keep that in mind. But again, not really overly bearish at all when you're looking just at these monthly charts. Okay, let's move into market profile now. There's a couple of things I wanted to point out here that kind of jumped out at me in Friday's activity. Friday was the first pretty strong down day that we had. Remember that a lot of the down action happens overnight, so it's in the gap. So for instance, when you see that the Dow is off 622 points, which it was on Friday, S&P down 81, remember that's measured from the prior day's close, which is all the way up here at Thursday's settlement. This area here, which is the red arrow in between, that's all in the gap. So that being said, the actual trading action, which is here in Friday in this distribution, there's two key things I wanted to point out, and then I'm going to give you a tip on how you can play this sometimes, which I think you'll find very, very valuable. First thing I want to point out to you is the simple fact that it is a double distribution on Friday because it has this row of single prints in between. Double distribution means when essentially there are two distributions. That's one distribution. And that's two distributions. And the way that market profile theory works is upon the next day, when you are trading back inside of that range, you treat each distribution as if it was a separate day. And then you also treat this area in between, which are the single prints, you treat it as an area of potential resistance there or there, in terms of the high or low. Either of the endpoints can be resistant. And you also look at it in the way that if prices were to trade up into here, they probably resist a bit the first time, but if they can clear that and they go in, this usually has very little resistance and you'll go to the other endpoint. You'll kind of go right through it because those single prints are kind of like a void. Basically, in the profile where each column of letters represents a 30-minute period, you can clearly see that in this particular 30-minute period here, very little time was spent. Only this one letter kind of shot down there. So basically, what does that tell you? Shorts were hitting the button at market. Shorts were also having stops triggered. Stops were being triggered. Okay, this is a sign of emotional trade. And when you put it all together in terms of looking at it as the whole day, and you see the double distribution, it is a form of poor structure that you should carry forward that is not indicative of longer-term institutional money. Remember, the longer-term institutional money would not act this way. It's more indicative of panic selling. And this could easily be the case because remember that a lot of the activity on Friday was driven by the fact that Amazon gapped down strongly and was down all day, end of the day down 187 points. And Apple rallied early and then reversed all of those gains and started to fall hard. So that potentially brought some kind of more panicky emotional selling into the market. So carry that forward. The next thing I want you to take home with you and carry forward is the fact that the low was very poor on Friday. What is a poor low? A poor low is essentially a low that has no excess. It means that the auction did not complete properly to the downside. This is an excess high. You see here these skinny single prints at the top. It tells you that the auction ended with a bang and not a whimper, and that's how every auction should end. This auction didn't really end properly and gave us a poor low. Now, what does that mean? How do we interpret it? And more importantly, how can I make money from this? Let me explain. The poor low, or poor high for that matter, but in this case, we're going to talk about the poor low. The poor low always has two implications. The first implication is that prices should move away from the poor low first. That is a tradable event in and of itself. When I see a developing poor low forming on the day time frame, for instance, as the day is unfolding, it's a good spot to go long because prices will push against the poor low because very simply sellers are obviously not able to press down below that level. That's obvious. In the bigger picture, once the move away from the poor low has happened, the poor low should be carried forward in your narrative because it needs to be repaired. Much like charts don't like gaps, the market profile doesn't really like highs and lows that are not complete. The auction needs to complete properly by having some good selling below there and building out this profile. Obviously, it would happen in a second day, but you could kind of pretend that you could cut it here and paste it over here. Basically, just building this out so it looks more like this so that it has its proper bottom to it. That's called repairing the poor low. So a lot of times what you can do is when you see the poor low, again, as I was saying, you play it both ways. You have that push away from the poor low, which you can get long, and then you can mark off the poor low as a short point because it'll give you better confidence that you'll potentially break through that poor low when you get it because the poor low is different from just any other low. I totally understand that you could easily say, oh, well, I'm just going to short the market when it goes, if Monday goes below Friday's low, I'm going to short it. That's true, and that can sometimes work on a lot of different days, but I'm telling you that it works better if the low is poor. You have much better odds that the market will follow through. So that's something that I will personally be looking for on Monday. If we were to open up inside of Friday's range, the poor low would definitely be a short for me, and we could go lower. Now, another way you can make money with this, although not now because it is the weekend. Over the weekend, there's always greater risk of news that can gap the market big on the Sunday night 6 p.m. Eastern open. So I don't recommend doing what I'm about to tell you on a Friday, but any other day of the week, it can work really, really well. And the way that it works is simply this, and you have to have market profile software for this, but it's definitely worth it, is if you see the poor low forming, you basically wait until right around 4:10 to 4:12 p.m. in the afternoon, just before the futures close. And the best case scenario that you want, is to have the futures close as close as possible to the poor low as you can. Okay, and if they close close as possible to the poor low, then you know that you can buy the futures right at the close. So you would essentially buy the futures at like 4:14 p.m. so that you can get your order and your basis to be as close to settlement as possible. And again, we're assuming that the settlement is very close to the poor low. And then what you do is you just basically start to limit out overnight because the odds are very strong that because of the poor low, there are a lot of sellers trapped here at poor location who were expecting this. They were expecting the break below the poor low, but they didn't get it. And that's why you'll see overnight the futures will trade like all the way up to here overnight. But again, something you can do on a Monday to Thursday, not the best idea to do on a Friday because you have that gap risk on that, that Sunday night open of the futures. And then last but not least, to tie it all together, remember, in terms of the carry forward, not only do you carry forward the poor low as a potential trade, but you carry forward the structure, the two parts of the poor structure, meaning that the low was poor and you had a double distribution, carry them forward in your narrative in the sense that, as I was saying earlier in the video, that is not how longer term traders act. Now, that being said, very often the beginnings of moves can kick off on poor structure. That's why I'm a big believer you have to be very careful with this whole poor structure thing. A lot of people will mistakenly continually hang their hat on poor structure and they'll see a move down and they'll think it's a pullback that they have to buy because the structure was poor. You don't want to do that. You want to always treat structural deficiencies as just single data points. They are one data point inside of a narrative that should encompass lots of other data points as well. Now, in terms of coronavirus vaccine or other, in terms of that whole storyline, Gilead seems to get all of the attention. But looking at the chart here, it is really one basically untradeable mess, if you ask me. I mean, there's just really nothing you can do here other than maybe potentially some selling of credit options, but directionally, there's really nothing we can do. So in the same storyline, however, two stocks popped up for me in my scans that I thought looked much better, much cleaner. And those are Lilly, which you can see here has a nice reversal at the 20 MA, obviously so much stronger than what the broad market is doing. Notice that the reversal came in ahead of the prior highs. If the reversal doesn't hold, then maybe it's going to be at the prior high at 146. So I'm going to be looking for either the move above Friday's high, or if we pull in a little bit further, then it's going to be the bounce here at the 147 area. And the other one is Regen, Romeo Echo Golf November. Huge relative strength on Friday in that it didn't even make it anywhere near Thursday's high, as the market sold off quite a bit, as we know, well above trend, well above 50 MA. If we do go a little bit lower, I'd be looking at trend line here. The only thing that's tricky with Regen is that they are going to report. That is going to happen on May 5th. So you may want to wait for that activity to end before getting involved. And that's all for this week. Thank you as always for spending just a little bit of your weekend with me. So just to recap, remember, we did come off pretty hard on Friday, but pay attention to all the nuances I talked about. If you're gonna be shorting the market, make sure to pay attention to what the NDX and the Russell are doing at the same time. Those of you that are into market profile, remember, poor structure on Friday and the poor low. If we open up higher on Sunday evening, don't be surprised, because remember, that's the first indication of the poor low. It should open up away from it. If we break below it, then consider that the poor low is getting repaired and you're moving below it. Opening inside of Friday's range, you've got a signal below Friday's low because you know that that poor low is there. So it's an easier short than if the poor low wasn't. Last but not least, I want to remind you that when I talk about things like market profile in these videos, remember that I'm looking in the rear view mirror. I'm only able to speak to you folks once a week on the weekends on these videos. But I write a report every single morning on the market profile, analyzing those distributions, where we look ahead and give out some scenarios and key levels as to what I think is going to happen that particular day. That comes out every day to my subscribers at 9 a.m. Eastern sharp, so you have a full half hour before the market's open to digest all of that information and set your trading plan for the day. That's the Peter's Pre-Market Perspective. It's only $20 a month. It's probably one of the best bargains in trading out there. No contract. You can cancel anytime. If you're interested in checking it out, there is a 5-day free trial, so you can read the report for a week before you decide if you want to commit to it. Go to ShadowTrader.net, mouse over the Futures Market Profile tab, and select Peter's Pre-Market Perspective. If you enjoyed this video, please hit the like button below and subscribe to our channel. On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.